Welcome to the Biz Easy podcast, where small business is simplified for greater results. Brought to you by Resources and Development. Go to www.resources-development.com for help in taking your business to the next level. And now, help me welcome the host of the Biz Easy podcast, Steve McCrillis.
Welcome to the Biz Easy podcast, your resource to help take your business to the next level. My name is Steve, your host, as we all learn to stay better focused on the things that make you great. Now, I'd like to introduce you to my partner and our resident guru of coaching, our lead business coach, Skip Williams.
Hey, thanks, Steve. Hey, did you know the word swims upside down is still swims?
I did not know that.
These are the things that keep me up at night, you know?
Oh, okay.
This week,
That's a little scary.
This week, Gene from Texas asked, do you have a good method for pricing goods and services? And I wanted to thank Gene for asking this because it's one of my favorite topics. But it's a topic that seems complex, but it doesn't have to be once you've done it a couple of times. But do let me warn you that this might be a little bit too technical for a podcast. So I wrote the blog about it, which can be found on our website.
And to remind our listeners, the website is www.resources-development.com.
All right. So first, when we're pricing, we had to decide whether we're pricing SKUs or units. If your company makes a specific product or provides a specific service that has the same scope of work, then we need to price by the SKU. Other products and services, however, need to be priced by the hour, the minute, the pound, the foot, and so forth. That would be the units. But whether you're pricing by the SKU or by the unit, the method is pretty much the same. The difference is one is a commodity with a catalog price, and the other usually requires you to provide estimates and or quote your customer.
Hey, Skip, can you give us an example?
Yeah, sure. Things like lumber, propane, carpet, laundry, produce, those are usually sold by the unit. A computer, packaged items, clothes, refrigerators are sold by the storekeeping unit or SKU or SKU as we call it for short. So let's understand the pricing, but we got to understand the pricing as a two-part calculation. We're going to do a lot of calculations to figure out what the value of something is or what it costs us to produce it, right? And we'll discuss that a little bit more in just a few minutes. But the second one is looking at what the market will pay for that same product or service. So doing some competitive analysis, of course, is important. But then when you have both numbers in front of you, you'll know if your business or this product line is viable. Obviously, if the first number is larger than the second, in other words, your cost is larger than the prevailing pricing out there, your venture isn't feasible. And conversely, if it's less than the second, then you do have opportunity.
So wait, how do we make those calculations?
Well, here's the method. And again, please refer to the article on the website if go too fast or if you miss something. But most of you know how to estimate your time and materials to calculate your raw costs. I would encourage you to also add other variable expenses that can be estimated on a per SKU or per unit basis. Those might be products or services that consume large amounts of energy, or sales commissions, or online sales fees, even employer share taxes and benefits, etc. Those things should be going into your cost of goods when doing these calculations. Once we've established that raw cost, we then need to add burden to that cost. Now, the burden is just what share of the overhead do we want the product to pay for? So in order to do that, we have to first look at your profit and loss statement and separate your fixed expenses or overhead from your cost of goods or your variable expenses. So
in my experience, we've actually run into a lot of concerns. Many clients don't know how to allocate part of their overhead or what does constitute a variable cost versus a fixed cost. So are you going to make us do the math now?
Yeah, but let me just separate that for you. Think of the expenses on your profit and loss statement as which ones are necessary to create the product or service that you deliver? And then what expenses would you have even if you had zero sales that month? So if it's something like rent, that's ongoing, that's fixed, insurance and things like that, even management salaries. But the people who have the hands on the product, turning the wrench, or uh, or providing the service, or making the product, that cost, that labor, the raw materials, and again some of the other ones that I suggested, all go into the cost of goods or the variable expenses. So yeah, pricing is math, or as they say across the pond, maths. I will endeavor to make it as simple as possible, but folks may need to refer to the blog, like I said. When we have the total cost of overhead, again, those expenses have nothing to do with producing the product or service, we then need to divide that number by the cost of goods and services to obtain the burden rate. And yes, I said divide cost of goods to divide by cost of goods, not by total revenue. And this is a common mistake because we're used to dividing everything into our gross revenue. But what we're trying to do is we're working from the bottom up. We're working from costs to the price or the revenue. So we have to divide it by cost of goods. So then we have a percentage that we can add to our raw cost to know that we've covered our cost to produce the materials, and we've covered a share of the overhead. And if there's more left over after the overhead, then of course that's profit. So let's say, for example, our percentage was 50%. So we multiply our raw cost by 1.5. This new number is the number we could afford to sell the product or service for that would cover our costs and our overhead.
But hold on for a second. We do have to factor profit in there. I mean, one of our podcasts is managing for profit. So did I miss something?
No. We're getting there. So now we have the total cost, including overhead and cost to produce the goods or services, and then we need to figure out what kind of profit margin we want to add on top of that. And I usually recommend looking at industry averages, or sometimes just simply what you think is fair. In some industries, that could be 5 or 10%. In other industries, that's going to be 50 or 60%. It really depends on your industry and what will keep you competitive as well. So again, now's the time where we're going to look at the price that we've got in our hands and compare it against what the marketplace is bearing for the same or similar products or services. So a few things to beware of. When adding your profit margin, we need to convert that number to markup, because margin works from price to cost, whereas markup works from cost to price. So for example, a 10% profit margin is what you're aiming for. The markup would be 11.11%. And the article can give you the formula to calculate that if you need to. So that would give you a 10% profit margin by adding 11.11% to the cost plus burden. Also, be careful with industry average margins, as they are usually based on raw costs and not fully burdened costs. So do be aware that not everybody calculates these things the same way. Overhead as a percentage of cost of goods will vary as your business grows or shrinks, right? If our fixed cost is $10,000, if we amortize that across $100,000 worth of revenue versus $200,000 worth of revenue, that percentage is going to grow or shrink as the revenue changes. So you'll want to adjust that or recalculate that burden rate from time to time, especially when your revenue or your costs, for that matter, make a big jump or change. Sometimes we are in a startup situation, though, when we don't have any history to go by. So in that case, we have to use the pro forma and look at the revenue, the projected revenue and expenses, and work from there, and then adjust as soon as you've got maybe 6 months worth of history. As revenue grows and overhead remains the same, the cost to deliver your product or service goes down, amplifies your bottom line. So sometimes if your pricing is not getting resistance in the marketplace, just leave it at that price, even though you're more than covering your burden now. And you should see a significant drop to your bottom line. Pushing price thresholds should also be a consideration. We can talk about that later when we talk about price increases, but that's certainly a strategy as well. So, Gene, as I complete this response to you, I'm realizing that I may not have made it as simple as I had hoped. If you or anyone listening or reading this struggles to get pricing right, please know that you're more than welcome to reach out for more clarification.
So let me ask you, Skip. I know that people use the thirds rule, and I've run into many clients who, I don't know if you know what the thirds rule is. It's 30% for labor, 30% for material, and 30% for overhead, and then leaving 10% naturally for profit. And that's how they use their budgeting. They've never taught anything different. That's probably an old school philosophy of doing things, but it seems to me that this will take a lot more calculation, and I don't think that we can really dig as deep as we want to with individual clients as to how they should price their goods based on this. Would you agree with that?
Well, I'm glad you brought that up because there's a lot of industry type calculations. For example, in the restaurant business, typically they will take their food cost, double that, and call that their menu price. You don't know whether you're covering your overhead or not if you use that method. And frankly, the labor is as important, if not more important, than the material costs. So I guess what I'm saying is there are a lot of different methods that have been used over time. We've always done it that way, type of a thing. But your cost, you may have a much more palatial restaurant than the next guy. Your overhead costs are going to be higher. You need to make sure that you are covering your cost, your raw costs, as well as your overhead, and then adding profit. So this is a method that will keep you out of trouble from those fairy tales methods that have been used for decades.
So we have to circle back to an earlier part of your comments, and that is you have to separate what is variable cost with what is a fixed cost. Again, I think QuickBooks, who most people use, or Peachtree, or any variation thereof, they do a fair job of putting in your chart of accounts those things that will qualify for that. But there are so many variables to that. So it really requires you to take your chart of accounts, your bookwork, and decide what is overhead so that you can have determine your overhead allocation necessary before you can do that. Is that a fair statement?
Yeah, I mean, QuickBooks will categorize anything you want as cost of goods, and by the remainder would be all fixed expenses. But you've got to set it up that way. And I find an awful lot of small businesses don't. The accountants set it up, and they don't care what's cost of goods or what's overhead. They just want to know the total amount of expenses for tax purposes. So yeah, a little work on your P&L will help you and make these calculations. But let's say they are just one list of expenses all jumbled up. You just need to stop and look at each one of those and ask which ones go into the product or service that you provide and which ones are overhead, and then add the two sets of numbers up, and then you'll have the two numbers. But you're right. You're absolutely right. A lot of people are not taking advantage of QuickBooks the way they should.
Well, another issue that I run into more often than not, when a client is struggling for sales and they are desperately trying to match bids, they try to they do what is called sharpening your pencil and determine if they can take on the job, where they will discount their normal markup on product or discount their normal material cost. And they'll also try to discount their labor to come up with the right number. Obviously, discounting in a circumstance like that can throw your entire profit margin all out of whack, and you can, at some level, be giving it away, and you're really not making money. But they do it because they want to make sure they have some business. And I said, the explanation or the metaphor that I gave them, it's like taking a $25,000, talking about a general contractor, taking about a $25,000 remodel project and discounting it. And then when you're done, give another $5,000.
Mm-hmm.
So basically what you're doing is you're giving your work away and you're adding your own cash to it.
There's a few things to remember. One is if you have to sharpen your pencil to the point where A, you're not making money or you're not covering your overhead, then wouldn't it think about it this way? Wouldn't it be better if your competitor took that job and he lost money on it? That would keep him tied up on a unprofitable job while you go out and look for the next job. Having said that, there are jobs that are so big that you're looking at the volume of it and you're realizing it's going to keep everybody busy. It's going to keep the lights on. And if you don't make much profit, it may be okay. But those are extenuating circumstances and oftentimes a mistake because now you're so tied up on this job that you're going to break even on that you can't go out and look for the job that you can be profitable on. So you really need to be careful. And when I talk about discounting, and we may talk about this in a future podcast, but discounting, we know what's in it for the customer when you discount, but there should be something in it for you. For example, if I'm a salon or a spa and I'm busy on Thursday, Friday, Saturday, and Sunday, maybe I can afford to discount on Monday, Tuesday, Wednesday because those are my slow days. It's better to bring a little revenue in than none. Or a hotel that they have a shoulder season and a slow season. It's better to discount and again keep the lights on and keep the housekeepers working and so forth. But you've really got to make those determinations. If you want to discount, there should be something in it for the customer, but most importantly for you, there should be something in it for you.
Well, it's funny. I've coached many clients and told them this: if your competitors underbid you, they're doing it for one of two reasons. Number one, they absolutely understand their break even and true costs. Or number two, they absolutely have no idea.
Yeah. And it's usually the latter.
Right.
It's usually the latter. And it is unfortunate. There's a lot of your competitors are going to underprice themselves. I would say stick to your guns, deliver something that has a perceived added value to what your competitors are doing and charge for it. Otherwise, you're always going to be competing on price. Wouldn't you rather compete on quality or efficiency or reliability or one of those things that customers value just as much, if not more, than the product itself?
Well, to have a true understanding of selling more to make up the difference, I always use this example when I really have to break it down in simple form. So let's say you're going to run a taco stand. You buy taco shells for 25 cents. You buy all the fillings for 75 cents. Are you with me?
Yep.
Then you decide you want to sell them for 99 cents and make it up on volume. What's wrong with that picture?
It's the old hot dog vendor dilemma, right? That's right.
That's right.
But yeah, you might be able to over time reduce your costs because you're buying in volume. But why are you struggling so? And are you covering the cost of gas to get your hot dog or taco cart to where it needs to be, and your advertising and all those other things that might be considered overhead? You've got to take those things into consideration as well.
I think what I could offer in the few seconds we have left is understand what your true costs are. Know what it's costing you, as you pointed out, for rent, for utilities, for general overhead expenses, because that's what each one of the jobs, if you're going to make $100,000 and each one of those jobs has $10,000 a month worth of overhead, you know that you've got to factor at least $10,000 a month. Once you achieve your break even, well, then you can start playing with your numbers. But raising prices is in consideration for everything you said.
That's right. I think I want to repeat the word burden. Burden is a tool that we use that we turn into a percentage number that will help us offset our overhead with each and every sale on a equitable basis. So always get that burden in the calculation.
And I'm going to invite everybody to reach out at skip@resources-development.com, and he can help answer those kinds of questions for you. We have that Ask the Experts on our website. feel free, anonymously or otherwise, reach out. We'll be happy to give you some points that might help you through the process. In the meantime, any last words, Skip?
Now, pricing is just one of those things that you cannot take the traditional methods. You've got to do the homework and do it properly. That's all.
Great. Sounds good. And speaking on behalf of our team here at BizEasy and Resources and Development,
That's a wrap.